And Hans Goetti, who is an independent research consultant, is joining us right now on the show. Hans, thanks very much for taking out the time. So at least some stability on the global front with regards to even Brexit, with regards to the trade talks. I mean, obviously, the issues with the trade talks are not escalating, but they're still on simmer. It's not like it's gone away completely, but the market is okay with that. What's your sense on what global equities do from here?
Well, we have to distinguish between equity prices and fundamentals, because there's clearly a disconnect here. I mean, what is driving equity prices at this point is liquidity. I mean, the Fed has injected $300 billion into the repo market since the beginning of September, essentially buying treasuries, and it's the same effect as QE. So you could say that the Fed is back into QE mode after having lowered interest rates 3 times. And that spills over into global risk assets, and therefore I think that the path of least resistance in the equity markets, not only the US but globally, is up, so is higher. At the same time, we have a slowing global economy, manufacturing and capex in recession, and a lot of debt in the world, which makes it difficult to stimulate the economy. So what we have here is a disconnect between risk assets and the fundamentals.
What is the expectation with regards to, how the entire fundamentals and also interest in putting money into some of these Asian markets or emerging markets would look like? I mean, when we're looking at China, we've got a growth rate pegged for the next decade at anywhere between 4.5% to 5% odd. You've got India, which has recently got a low print in terms of its GDP numbers itself. But where exactly is the money flowing to?
Well, emerging markets is one. Emerging markets clearly benefit from easier monetary policies around the world, and also potentially from a weaker dollar. The dollar hasn't weakened decisively yet. It has had a very strong spell over the past few years. But to us, it seems the dollar could roll over, simply because the Fed may be forced to cut interest rates again next year and then catching up with the whole world. So a weaker dollar would be good for the emerging market space. And you mentioned China and India. India, yes, it's slowing down. China as well, but you have pockets of strength. For instance, in China, the technology sector offers tremendous opportunities, because China will have to make sure that they do not depend on supply lines that from, or the supply chain. They will develop their own technologies, and I think there's a tremendous opportunity there in the next few years for investors.
Hence, you highlighted the rally that we've seen for global equities has been liquidity driven, and that's absolutely true, because back home in India as well, we've seen the flows picture at least looking better on year-to-date basis. Do you then expect this liquidity driven rally to continue even in 2020, or do you foresee any change in asset allocation? Can the preferences change from equities to something else?
You see, what we have to bear in mind, of course, is that equities are no longer cheap by any standard. But for now, as long as the central banks keep pumping liquidity into the system, we think that equity prices could go higher. Another asset class which we like based on fundamentals will be treasury bonds. I know this is a bit controversial, but we don't see inflation as being a threat. We actually see probably a slowdown in the economy in 2020 rather than a reacceleration as so many people expect. So I believe that the long-term treasury bond yield, which is currently at about 1.84, could go a lot lower. And that, I think, opens a great opportunity for patient investors in the long-term treasury market.
Okay, and what's the overall view for India? You said, of course, the flows could be seen in emerging markets going ahead as well, but there are some divergent moves with regard to growth rate. The GDP is at 6.5-year low, but the equities are at all-time high. How do you approach the Indian markets?
Well, in India we have a slowing economy, but at the same time you have fiscal stimulus. I mean, we had the tax cut for corporations, and we'll see what the budget will bring. I think there are calls for tax cuts for individuals as well. I think where we see the limits, and that's not only in India, that's everywhere, the limits of monetary policy to stimulate the real economy. I mean, if you have loose monetary policy, yes, it drives asset prices, but can it really stimulate the real economy? And I think that's where probably Fiscal policy has to come in despite high deficits. So we'll see how that's going to play out. I think in India you also have inflation above the target, but I think that's mainly because of rising food prices, like is the case in China. So I think there's a combination probably still looser monetary policy, but a lot more fiscal stimulus coming.
The budget's going to be an important watch in the month of February for India. Possibility of some personal tax cuts, which once again helps spur consumption, which has been sputtering so far. But my question, on the other hand, is also with regards to something that was recently announced, which could indicate more passive funds, almost to the tune of $2.5 billion that would come in from FPIs into the country because of tweaks in the FPI investment limit at a corporate level. Do you feel that that could be a possibility and that could help raise investment sentiment?
I think it could. First of all, India FDIs are very long-term. It's long-term money, and India is a great secular growth story. There's no question about it. Despite some cyclical issues that exist, I think the money flows will be positive going into India over the coming years.
Okay. If the flows pick up, Hans, due to such action by MSCI or otherwise, do you reckon the overall valuations could creep up higher despite the long-term story possibility being there? People are questioning the valuations with which India is trading currently.
Yeah, I know. I mean, that's true. It's not a cheap market. As I mentioned, the U.S. market is not cheap either. There are other markets in the world which are cheaper. Europe is one. Japan is another one. But I think valuations, if the story is good, valuations maybe don't matter that much in the near term at least. So I'm not pessimistic on India in that sense. Yes, there could be a bit of volatility, but in the long run, we strongly believe in the secular growth story in India.
Okay, Hans, one final question from my end at least. When you look at the Asian landscape, a lot of people, including CLSA in the recent conference that they were here, mentioned the possibility of how the other North Asian countries look a lot more attractive, and therefore on a relative basis in the near term, India might not get the lion's share of the flows, it will be other markets. And we all know that right now it's liquidity which is driving the valuations higher for almost all markets. Do you think on a relative basis other markets might be better off?
Well, possibly. I mean, it depends a bit on how the trade story plays out. I mean, you have Korea, you have Taiwan. These are economies which are really tied into global trade. And if you see some less tension in that department, I would think that these should be the beneficiaries. And I think valuations are a lot more reasonable there than in other parts of the world. One market we like in particular here, which may not be part of the Asian universe, but it's still part of Asia, is Japan, because Japan has a lot more attractive valuations than the US, and in Japan we have seen 2 or 3 lost decades, and so Japan therefore is a lot further advanced than everybody else, and Japan is no longer alone, and a lot of bad news in Japan is in the price. So I think that with an emergence of new equity culture, rising dividend yields and so on, we think Japan is a great story in Asia.